Donald Trump expected hard words from rivals. What surprised him was the quiet retreat of smaller partners. They slipped away without fanfare. Now a slow but powerful change is happening. Travel warnings, trade talks, and new alliances are shifting long-standing economic ties. The immediate picture looks like empty shifts in factories, canceled contracts, and stock graphs that swing wildly. Behind those numbers lie towns, jobs, farms, and supply lines. The choices Canada made are not just about new friends. They are altering the map that big American companies built for decades. For 7 household names, the ground is shifting beneath their feet. Their old advantages are shrinking. Their plans must change fast, or whole business models may break. This script follows those companies and the people who depend on them. Walmart built an empire from low prices and massive logistics. Its warehouses near the Canadian border look like small industrial cities. Conveyors hum. Trucks line up at loading docks. For years, Walmart moved goods across the invisible line between countries. That movement created jobs for thousands. It made Canadian stores easier to stock with American goods. Walmart optimized its system for that flow. It designed almost 50 distribution centers to serve Canadian routes. It hired thousands of workers whose paychecks came from moving American products north. The company counted on steady Canadian sales that added billions to its bottom line. That steady stream kept growth humming while e-commerce changed how people shop. Then Canada widened its circle of trade partners. South Korean electronics makers now ship more directly to Canadian stores. Japanese brands use new Pacific routes that skip American warehouses. Australian farm products reach shelves without passing through American processing. The old advantage of being close suddenly mattered less. When a retailer's edge depends on geography, and that geography stops being the fastest route, the edge fades. Inside Walmart, internal reviews show projected drops in market share. Some models suggest a loss of about a third of Canadian business as new partnerships take hold. Facility use rates fall. Executives consider consolidation of distribution centers. They imagine retraining or relocating thousands of workers. For suppliers that made goods just for Canadian shipments, the picture is worse. Orders shrink or vanish. Trucking firms that specialized in cross-border runs face route cuts. Small towns that grew around Walmart hubs watch their largest employer hedge or withdraw. The ripple moves backward through the supply chain, pulling at local economies and family incomes. For Walmart, it is not just losing sales, it is losing the network that made those sales possible. General Motors once stood at the center of integrated North American auto manufacturing. Plants in the United States and Canada worked like clockwork. Parts flowed one way. Assembled modules returned another way. This system cut costs and tightened delivery times. General Motors engineered production to depend on this continental choreography. Canadian assembly lines relied on American parts shipped carefully just in time. The new trade ties changed that choreography. South Korea and Japan already make parts to world standards and often at competitive prices. Preferential trade deals and faster regulatory paths make those foreign parts more attractive to Canadian manufacturers. Suddenly, a Canadian factory can source brake systems or electronics from Asia with a tariff edge and faster approvals. That eats into GM's integrated model. The danger is deeper than lost sales. GM's strategy was integration itself. The company built factories with the expectation that an Ontario plant would need parts from Michigan or Ohio. When Canadian plants begin to sign partnerships with foreign suppliers, GM must rethink everything. It must ask hard questions. Should it rebuild supply lines? Can it match the speed and price of rival parts? What happens to steel, rubber, and electronics suppliers in American towns if Canadian contracts shift abroad? Internal GM documents show emergency planning underway. Executives speed up redundancy efforts and look for new joint ventures. But changing a continental production network is costly and slow. Machines and tooling are specific. Workers are trained for particular parts. Suppliers' businesses are specialized. The shift threatens whole clusters of American manufacturing. If Canadian assembly plants prefer international parts, GM risks seeing assembly lines slow, orders drop, and communities suffer the consequences. Energy is the next fault line. ExxonMobil grew into an energy titan on networks that crossed the northern border. Pipelines carried Canadian crude to U.S. refineries. Processing plants in America turned raw resources into fuels and products. That integrated approach made sense for decades. Canada had resources, and the United States had capacity to refine them and move them to global markets. Now Canada has other friends who bring alternatives. Norway, with its energy tech and export networks, becomes an attractive partner. The United Kingdom brings finance and expertise. Australia shows interest in joint ventures that keep more of the value inside Canada. The result is a reorientation of how Canadian energy moves, For ExxonMobil, the threats are concrete. Reports suggest large reductions in the flow of crude to U.S. systems over the coming months. Lower pipeline usage means refineries operate below optimal capacity. Refinery margins slip, maintenance and staffing costs remain, but revenue drops. The company's financial forecasts show serious shortfalls if access to Canadian supply is reduced by significant percentages. Stock prices react. Investors worry about long-term fragmentation of the continental energy market. If Canada builds refining capacity with foreign partners or routes its oil and gas to Asian markets without U.S. middlemen, ExxonMobil loses not only volume but strategic influence. The company may need to restructure capital projects, retrain staff, and find new markets for products that once relied on steady Canadian input. The human impact hits refinery towns and pipeline workers. Local economies tied to American processing face layoffs and a long road to recovery. Food and agriculture sit on top of many fragile chains. Cargill moved grain, oilseeds, and processed foods across borders for decades. Grain elevators, processing plants, and transportation firms formed a system built on predictability. Canada depended on American agricultural output for significant parts of its food supply. Cargill's cross-border networks channeled billions in crops from American fields to Canadian processors and stores. That flow supported farmers, truckers, and rural banks. Now new trade partners bring alternatives. Australia and Brazil can supply grains and soy more cheaply or through faster routes. They also offer volume and different timing that undercut American offerings. Price advantages appear on paper. Preferential terms mean Australian wheat, for example, can enter Canadian markets with noticeable cost edges. Brazilian soybeans benefit from expedited processing arrangements. The predictable river of American agricultural goods could become a trickle. For Cargill, that means less throughput and pressure on terminals built for steady high volumes. Facility economics depend on that constant movement. If volumes fall, profitability follows. The results ripple across farming communities that rely on Canadian buyers. Farmers in states that send large shares of their harvest north find demand falling and prices slipping. Local lenders watch loan covenants break. Equipment makers and parts suppliers lose contracts. Towns built around elevators and processing plants face closure or consolidation. The impact is not only economic, it is personal. Centuries of farming knowledge and local networks suddenly lose their main market. Adjusting to new buyers takes time. Finding new buyers may mean different quality standards and logistics. The stress lands on family farms and the workers who depend on them. Technology flows face their own disruption. Microsoft is more than a software company. For 2 decades, its data centers and services linked Canadian digital life to global markets. Banks, hospitals, and governments relied on Microsoft's infrastructure for daily operations. The company's Canadian units handle billions of transactions and run data centers placed to serve local needs and regulatory demands. That presence created revenue and jobs. It also built a bridge between Canadian digital systems and the wider world that passed through American networks. Now Canada is building alternative digital routes. New data cables and partnerships connect Canadian networks directly to Asia and Europe. Countries like Singapore and South Korea offer advanced data processing and lower latency routes to Pacific markets. Switzerland provides well-regarded data security frameworks attractive to banks. The United Kingdom contributes AI research and partnerships that mesh with Canadian innovation. These alternative pathways let Canadian data travel without touching American infrastructure as often. When data can move directly from Toronto to Tokyo or Zurich with less friction, Microsoft's geographic advantage erodes. Inside the company, risk assessments show falling projected dependence on American networks. New routing reduces the volume of traffic passing through Microsoft's systems. That translates to revenue impact and re-evaluation of data center investments. For workers, the effect is hard to measure but real. Engineers and technicians whose careers focused on integrated North American systems may need new skills. Research collaborations that once went through American intermediaries now connect directly to foreign partners. In short, the digital geography that Microsoft relied on is rearranging itself in ways that chip away at incumbents. Finance depends on trust and network effects. J.P. Morgan Chase built an immense presence by being the financial gateway for many international deals. Canadian corporations used American banks to access global capital markets, manage currency flows, and handle complex financing needs. J.P. Morgan's Canadian business generated substantial revenue and cemented ties with mining, energy, technology, and agricultural clients. Those ties gave the bank scale and influence across borders. Now other financial centers are stepping in. Switzerland's banking tradition and Singapore's Singapore's connections to Asia offer different pathways for Canadian firms. The United Kingdom's financial sectors, especially after Brexit adjustments, view Canada as an opportunity. Firms there offer services, exchanges, and market access that sometimes come with lower fees or faster execution for certain trades. Canadian pension funds and insurers begin to test direct partnerships that bypass U.S. banks. The result for J.P. Morgan is a shrinking client base for some high-value services. A decline in foreign exchange volumes and a drop in managed assets can hit the bank's international economics hard. The bank's internal reviews show falling client retention in some segments. As Canadian companies move to alternative capital flows, J.P. Morgan faces both top-line and cost pressures. Losing large institutional clients is not merely a revenue loss. It reduces economies of scale. The bank may have to change staffing, technology investments, and compliance systems designed for a more integrated market. Lobbying increases as firms push to preserve critical infrastructures and regulatory relationships. But political influence has limits when corporate clients find better or cheaper alternatives abroad. The consequences for employees and regional financial centers are meaningful. Investment advisors and traders who specialized in North American cross-border flows face client churn and work uncertainty. At the top of the list sits Caterpillar. Heavy industry and construction equipment makers rely on global projects and steady demand from infrastructure work. Caterpillar's machines build roads, mines, ports, and pipelines. Its pieces of equipment are the backbone of many national projects. For decades, Caterpillar placed factories, distribution centers, and service networks to support customers across North America. The company's spare parts and engines kept projects moving on schedule. If the continental flow of large projects and resources changes, Caterpillar feels it quickly. Mines that once relied on American machines may now work with equipment providers that form direct ties to new suppliers or offer different financing. Construction projects might source engines and parts from companies that benefit from new trade terms. If energy and mining move under different regional alliances, demand patterns change. Caterpillar sees its order books alter. Plants that made parts for specific regional needs find less work. Distributors who stocked American brand parts see turnover slow. Service networks must adapt to new types of machines or find alternative revenue streams. For communities near Caterpillar plants, that adjustment is painful. Across all 7 firms, a common theme emerges. Decades of planning assumed a certain map of supply, demand, and trust. Companies built physical networks, legal agreements, and human expertise around that map. When the map redraws itself, those investments look less secure. Some companies can adapt. They may build new partnerships, shift production, or invest in different technologies. Others will face painful choices. Close facilities, lay off workers, or sell parts of their business. The speed of change matters. Rapid shifts mean higher costs and more disruption. Gradual shifts give time to pivot, but even slow changes can devastate towns and industries that once had reliable markets. The human stories are stark. Workers clock in and out in plants that may not need as many hands next season. Truck drivers learn their main routes will vanish. Farmers watch long-term contracts dissolve. Technicians who kept data centers running face new routing protocols and shifting demand. Families built around a single employer suddenly wonder how to make the next mortgage payment. The economic web is dense and local. When one big strand frays, dozens of smaller ones follow. Business leaders know the tools to respond. They can diversify suppliers. They can seek new markets. They can invest in automation and new skills training. They can cut costs and restructure. But these actions have limits and consequences. Automation reduces jobs. New markets require time and capital to build trust. Cutting costs can erode service quality and long-term competitiveness. The choice is rarely simple. In Washington and boardrooms across America, conversations change tone. Where officials once assumed continental economic integration was stable, they now see fragility. Lobbying grows louder. Executives call for policy fixes or trade agreements that restore advantages. Yet political solutions move slowly. In the meantime, market forces accelerate decisions. Companies not able to respond quickly pay the price. For communities, the answer will likely be a mix of public and private effort. Local leaders seek new investment. Governments consider aid or retraining. Private firms weigh whether to stay and transform or to scale back and reallocate resources. The most resilient places are those that can adapt, attract new business, and retrain workers. But not every town has that flexibility. Some will decline. Others will reinvent themselves. The broader lesson is simple and harsh. Global trade is no longer a predictable map of old alliances. New partnerships can form quietly and change the flow of goods, money, data, and energy. When a neighbor nation chooses new partners, the effects ripple far beyond diplomatic speeches. They reach loading docks, factory floors, server rooms, and kitchen tables. For 7 of America's biggest names, those ripples pose existential questions. Walmart must rethink distribution. GM must restructure integration. ExxonMobil must find new supply strategies. Cargill must navigate shifting agricultural flows. Microsoft must adapt to new digital routes. JP Morgan Chase must preserve financial networks. Caterpillar must follow demand to new projects and partners. This story is still unfolding. The choices companies make now will shape regional economies for years. Some will shrink and then refocus. Some will lose major market shares. Some will transform into different kinds of companies. What is certain is that a quiet rearrangement of international ties can have loud consequences at home. Those are the stakes. Towns, workers, and industries wait. The old assumptions about a continent connected through familiar routes no longer hold. The future will belong to those who see the new map and move fast enough to build a new path across it. Smaller businesses that supplied the 7 giants face a different struggle. They cannot pivot as fast as multinational firms. A machine shop that made parts for GM cannot easily retool overnight for a different industry. Trucking companies with fleets built for cross-border runs cannot immediately find local routes that match their margins. For these firms, survival means creativity. Some form cooperatives to share resources. Others find niche markets or diversify product lines. Many rely on community support and on government programs to bridge the gap while they find new customers. Consumers feel the effects too. Prices for certain goods may change as supply chains reroute. Some products may become harder to find for a season. In other cases, new partnerships bring fresher options, different brands, and new technologies. The change can be confusing. Shoppers notice different labels on shelves and wonder why familiar items are missing. Over time, markets adjust, new habits form. Some losses become gains in another form, but the transition is rarely smooth. Investors and analysts will write long reports about who adapted and who did not. Historians may one day point to these months as a turning point in continental economics. For now, the story is made in small decisions. A plant manager deciding whether to retool. A farmer choosing a new crop to meet foreign standards. A mayor negotiating tax breaks to lure a supplier. Each choice nudges the future. The companies themselves face a crucial test of leadership. Those that move quickly to diversify, to form new joint ventures, and to invest in people will have a better chance. Those that cling to old maps may find themselves shrinking. The winners will be those that see the new routes and invest in relationships rather than assuming old ties will always hold. That means tough conversations, bold investments, and often painful short-term choices for long-term survival. The human cost cannot be ignored. Even when economies recover, careers are disrupted. Workers may need new skills. Families may relocate. Communities must rebuild trust and opportunity. The private sector, governments, and local institutions will all play roles in easing transitions. The companies that recognize this and invest in people as well as profits will be the ones that rebuild stronger ties in the years to come. If you found this breakdown useful, they should hit the like button and subscribe for more deep dives into the trade stories reshaping economies. They should ring the bell so they do not miss updates as this story evolves.